Hey, everybody, what's going on? And welcome Sunday evening to our latest TDR Small Cap Sunday podcast. I'm your host, Shad Dales, as we keep this show rolling along and feature 5 small cap stocks that you may not be aware of. And tonight we feature 5 new ones, including a mainstream media company out of Canada that could be in big trouble, along with a fintech company and 3 other stocks that I think you'll like. We outline who they are and why they've grabbed our interest. So with that, let's jump into today's podcast once again and welcome in TDR lead analyst Bill McNarland. Happy Sunday evening. Good to see you.
How are you?
I am.
Good weekend?
Yeah, I had a very good weekend. And time is rolling along. We're almost into the month of October. Where does time go? It flies, doesn't it? At this point of your life?
Yeah,
We're a bunch of 1976ers. So it's like, when's your birthday? August what?
22nd.
Mine's the 23rd. Can you believe that? We met about a year ago, and here we are at opposite ends of the country, separated by 1 day of birth. But here we are, a bunch of 48-year-olds talking about small cap stocks. And why not, right? But I know you've been doing a lot of work. As I say, every single week you found 5 new ones. Obviously, the 4th one, Corus Entertainment. I used to work with that company, so I'm anxious to obviously get into that story because I know a couple of colleagues of mine that I used to work with are still involved in that company. It's been nothing... not for the faint of heart, the way that company has been operated and some, I think some acquisitions that they've made over the last 6-7 years have really come back and bite them in the hand, so to speak. But we'll get into that a little bit later. But as usual, all views on the Small Cap Sunday podcast and the guests on this podcast are purely opinion. You should not treat any opinions expressed by us or guests as investment advice, and the views on this podcast are solely intended to be informational and are not investment advice. All right, let's begin with our first company. It's a company called Comstock Holdings, trades on the NASDAQ under the ticker symbol CHCI. They're located in the nation's capital, Washington, D.C. Current stock price, $9.29. Market cap at $91 million. Shares outstanding are 9.8 million. Daily trading volume, a little over 100,000 at 109,000. So as I usually do, we first begin with the question, how has this stock basically performed looking at the 52-week range, Bill?
Yeah, so it's almost tripled this year. It's went from 390 was the 52-week low, and now it's 929. So it's been moving.
Okay.
The 52-week high was 987, just under $10. So there's been a lot of excitement been building about the company with investors.
Well, that's interesting. So that grabs my interest. So tell me a little bit about the company and what they focus on.
Well, I think, first of all, the excitement. I think how far the stock went down and the excitement is misunderstood.
Okay.
On both sides. So this is an asset-light real estate company that does focus on mixed-use projects, including office and commercial in Washington, D.C. area, near transit areas. But where investors get, I think they start dumping the stocks. They're like, well, I don't want to own anything that has to do with commercial real estate. And now people are excited because people are going back to work. But what they missed, I think, the message is this is an asset light model. And that's something we can talk about for a minute, the difference between asset light and traditional REITs.
Yeah, I wanted to ask what is the difference? So yeah, you want to maybe elaborate on that a little bit more?
So one extreme part of the spectrum is REITs. So if you have a REIT you buy of hotels, the hotels are not allowed to operate the hotels. You only can own the physical space and someone else operates it for you. That's a tax regulation to make it a REIT. So that's real estate heavy. There's no operating part of that business. And then the other end of the spectrum would be something like Holiday Inn, which is part of Intercontinental Hotel Groups. When you stay at a Holiday Inn, you're not, Holiday Inn just puts their name on it and is doing the operations. That's a franchisee that actually owns the real estate. So Intercontinental or Holiday Inn would be asset light. They get their exposure from real estate, but they don't actually own it. So this company is a bit mixed. They are an asset manager. So that means that if you and I want to develop a piece of property, they'll go in there and take care of everything for us. Also, they do some property management, and they also own some as well, but it's not a traditional, they didn't have this big exposure to people not going to work. So because of that, it was misunderstood. But this is a more consistent real estate play. If you want to benefit from real estate, but not get the full exposure to the ups and downs, this is a good play to have.
So does it focus primarily on commercial, not residential?
Not residential. So just anything that's around a subway station. So there's the commercial, there's some retail there. That's what their focus is on.
Okay, so stocks perform well over the last 52 weeks. So let's go to the charts right now. Look at revenue over the past 12 months and growth percentage. What are we seeing?
Yeah, so their revenue was $46 million on the year. Their revenue growth, though, was 13% last year, but
Okay.
over the last 3 years was 25.8%. So here's the point: when all that volatility was happening, people not going to the office,
Yeah.
they weren't experiencing that. They were just consistently growing. They're taking on more contracts. They're doing more services for real estate developers and such. They were able to manage that challenging period of time.
I'm curious to see how this will perform then, because as we've said before with commercial real estate in the US, and I know they're not completely focused on this is actually light. But when you look at interest rates and where they are right now, and a lot of these leases for a lot of commercial real estate is going to be come up for renewal for the next 6 to 12 months, will it be affected at all pertaining to that, you think?
Well, what's interesting is their asset management arm has contracts going way out. They got lots of people are doing different work that they want them to manage.
Okay.
But if you have an office building, let's say, and
Yeah.
it's half empty and it's not going well, you still need someone to manage it for you. And so they
Mm.
get revenue from those types of sources as well. So it's kind of the best of all models. The other thing that we'll find out when we look at their balance sheet is they hardly have any debt. That's what gets real estate companies into problems. But because they're asset light, they don't have that debt risk like the other real estate pure plays.
Okay, so a healthy gross margin. Revenue was pretty substantial at 46 million. You said balance sheet. What's the current cash situation? How much working capital currently
Yeah,
right
so
now?
so they're cash rich, with a market cap of 91 million, which was only 30 million in the last year when the stock was down. They have 21 million of working capital, 17.5 million of cash, and they only have 19% of their assets are leveraged. So this was just a bulletproof of a balance sheet that they've had and that they had. And the breakup value is $39 million, which is more than where the stock was trading earlier this year.
Yeah. Hmm. Cash flow statement. What are we looking as far as levered free cash flow?
Yeah, they had leveraged free cash flow of $10 million last year. So they were doing strong. Any problems in the real estate market haven't been affecting them because of the asset light nature. So there's no concerns financially here.
Do they provide a dividend or no?
No, no, they just reinvested back into their business.
Okay. All right. So long story short, you would obviously own this stock because regardless of what kind of condition commercial real estate is, and they have a obviously a position to manage this, and that's not going away anywhere anytime soon. Because whether it's empty or full, you're going to need their services to get people in there if it is empty. Correct?
Yeah, for sure. So that's why I like these type of asset light real estate plays, and they're rare outside of the large hotel groups.
Okay. All right. So Comstock Holdings, NASDAQ, CHCI, first green check mark here this evening. On to company number two, it focuses in the automotive industry. It's called Cooper Standard Holdings, trades in the New York Stock Exchange under the ticker symbol CPS, located in Detroit, Michigan. Current share price $14.01. Market cap 242 million. Shares outstanding 17.3 million. Daily trading volume relatively strong, 1.5 million. And, let's learn a little bit more about this company. So again, 52-week range for the stock showed what?
Yeah, so it's at $14. It's been between $11 and almost $21. So it's a
Okay.
little lower on there, closer to the bottom of its range. But definitely there's been some volatility there through the year.
So it focuses on the automotive industry, being from Detroit, of course. But you want to explain further on what exactly they do within the automotive industry?
So they actually build components on a vehicle. So let's say if you buy a new Ford vehicle, about 3% of the components of the vehicle were put together by them, and they were simply assembled by Ford. And so they work a lot with fluid transfer systems and such. But this stock and the automotive stocks are very volatile based on how well the economy is doing. So in 2018-19, this stock was just flying, was around $125. And then COVID came, there was a big hit. And then there has been some displacement in the automotive industry that's very unusual. Like we heard stories in the last couple of years of empty lots of car dealerships and stuff.
That's changed.
Eh,
That's
Yeah,
definitely
so
changed.
exactly. But one thing that hasn't changed, I want to pull up a chart here, and this is historically we've never been this far. Is the average passenger vehicle in the U.S. is 14 years old.
Are you well, I guess, when you go to southern states, they probably keep their vehicles a lot longer than what you see the north part of America, I would think, right?
Yeah, so a number of things happened here. So one, vehicles became better through time,
Yep.
especially domestically in the United States. Secondly, we had COVID and there was some financial challenges. Third, there was inventory issues where sometimes there was a period of time you couldn't buy a car if you wanted to buy a car.
100%.
So so it looks like now that this may naturally start sorting itself out. We're probably not going to get to an average age of 17 years of a car. People are more likely in the next 2, 3 years to buy cars than they have been in the past.
Gotcha, which I'm not surprised. Plus a lot of incentives going on right now because anytime I look at dealerships right now, the parking lots are loaded with inventory and there's a lot of incentives for people to get back into the game and purchase. So I think you have some valid points. But again, that stat was what is it, every 14 years on average?
Yeah, so when you're driving down the interstate, the average car is 14 years old.
That shocks me. Absolutely shocks me. In the US, it's 14 years.
Is the average. Yeah.
I guess.
Now, now the numbers are a little skewed when you look at trucks. Trucks are closer to 11 years, but
Really?
vehicles, cars are 14.
Be curious to see what it would be in Canada.
Yeah, I
You know.
imagine it would be the same.
Yeah. All right. What kind of competition do they have in this space? Do you know?
Well, so these go on long contracts. So right now they have some domestic contracts. They always want to they want to get into electric vehicles more, something that they're stating publicly they want to get involved in. But typically when you have one component for a vehicle and a vehicle their shelf life is 8 years for that style or model, a new competitor is not going to come in and replace it. It's
Yeah.
set up for that period of time. So these are long contracts. They're trying to improve their contracts. They've had some growth that we'll take a look at. But I think the bet here is that just cars in general are going to increase in volume.
Well, I think you're bang on with that, and not to mention long contracts. Everybody loves renewal business, right?
Yeah.
Year over year. Okay, let's go to the charts right now. Revenue past 12 months showed what along with growth percentage?
Yeah. So this is very high. Like revenue is almost $3 billion, $2.8 billion. So this is
Wow.
a significant company, and the growth has been there. 3% last year, 5.8 a year over the last 3 years. So there's definitely some significant revenue and some growth there.
Yeah, no kidding. Gross margins.
It's 11.3, which is 3% higher than its SG&A. So because of that, no surprise, it has EBITDA of $190 million. So put that in perspective. The market cap's 242 and their EBITDA last year was 190. So this sector is really beat up.
Well, as we said last week, two things to look at: gross margin and SG&A when looking at a small cap stock, right?
Yeah. And they get the check mark for that area. Yeah.
All right, balance sheet time. Current cash position along with working capital showed what?
Again, this is surprising. 93 million in cash, 220 million in working capital, which is almost their market cap. They have some debt legacy. They went through a period the last 4 or 5 years, had some challenges, but they have 109% debt for every dollar of assets. But that's working its way out with the amount of EBITDA that they're earning.
Okay, levered free cash flow.
It's real. So their leverage free cash flow is about $12 million in the last 12 months, but that's because they put $62 million into capital expenditures to improve what they're doing in the future. So that's a huge investment for the company. So that will translate potentially into more revenue in years to come.
Can't believe the revenue that they're doing. All right, last up, would you own this stock? Moment of truth.
Absolutely, absolutely. I like this kind of beat up, manufacturing. Like last week, we looked at a beat up manufacturing, but they were spending more on their SG&A. The
Yeah.
margins weren't there. Their balance sheet was awful. This is an example when a manufacturer looks strong, and I see this. I don't think no one wants to be driving a 14-year-old car.
No, and I think you're going to see a lot of purchasing of vehicles in the next year or two. That's for sure. There was supply and demand was a major issue in the last 4 or 5 years ago. And I bought my truck, which was, this going back 3.5 years ago. It was the only vehicle on the lot at the time. $98,000 for this vehicle. And there was no deal in place. So
Yeah.
Those days are long gone. All right, two green check marks. On to our third company called CoreCard Corp, New York Stock Exchange under the ticker symbol CCRD. They're based out of Atlanta, Georgia. Current share price $14.39. Market cap is $115 million. Shares outstanding relatively tight at 8 million. Daily trading volume a little over 600,000 at 622,000. All right, 52-week range for the stock. It's showing what?
Stock's $14. It was in a range between $10 and $22. But this was a stock that was 50 some dollars around COVID. So it's definitely backed off.
So what's happened?
This is interesting. So this is a stock that it has a long history as a company, but no one had heard of it until Apple and Goldman Sachs had this big plan that they were going to get into retail financial services.
Okay.
So Apple was going to, have the card. Remember, and Goldman Sachs was doing all the banking behind it.
Yeah.
And all of a sudden they announced that they were going to use the financial technology of a company no one heard of in Georgia. And so this company just, went way up. What happened to that story? Goldman Sachs has decided they don't want to be in that business anymore. Apple's still going to do it. That was the fault of Apple, and Goldman had a lot of issues. Apple wanted the statements to be out on the same day for everyone. They wanted to issue cards to people with poor credit. Goldman took a big loss. Apple didn't. Goldman said, okay, we're taking a loss. We don't want in this business. So this was an issue because 63% of the revenue of this company came from that relationship.
Oof.
So
the
stock's
issues
down. So that we have to look at this company to figure out a little bit more in depth, but that's kind of the story behind it.
Did Goldman Sachs really state in their press release as to what kind of issues they endured?
Yeah, so it had nothing to do with the company. It was the demands that Apple had for unusual things like statement dates. The second one was that the defaults of the people borrowing the money off the card were much higher than they modeled. Nothing to do with this company. No one's ever said they were disappointed in the relationship with the company. Everything was good. So they just happened to be an innocent bystander in this disappointing arrangement between Goldman Sachs and Apple.
So you said 63% of what was that stat again?
Of their revenue was tied to this deal.
So how have they been able to, I guess, pivot and maneuver since then?
Well, we're going to take a look. So first of all, the big questions we have is their financials strong enough to rebuild? There's nothing wrong with their technology. They have to go out and present this to other groups.
Yeah.
And the other thing too is Goldman and Apple gave them the big check mark of approval. So now it's just a matter of time that they have to spend the next couple of years building up business again. The stock's been hit, we know that, but do they have the balance sheet to be able to go out and do this again is the big question.
Well, let's look at that then right now and go to the charts. Revenue in the last 12 months, along with growth percentage, like you said, might have seen there's a story within the story is what you just indicated, but what did you find here?
Yeah, so the revenue is $52 million. It's been down, as we know, from the previous numbers I quoted. Part of that's already in the revenue number.
Yep.
But what was neat, when they were humming along, even this year, their gross margin's 32% and their SG&A was only 12%.
Wow.
So they were making a big transaction charging Apple and Goldman for this relationship. And so they came out with an EBITDA of 7.1 million in the last 12 months. So that tells you when they're partnering with people, they had something that Apple and Goldman were willing to pay for good margins.
Yes. So there's something there at least. All right, moment of truth time. Let's look at their balance sheet. What's the current cash position?
And this, So here now we look at it. They compared to their $115 million market cap, they got 27 million of cash, working capital $32 million, and their debts are only 17% of their assets. So they have a breakup value of 50 million and a credit rating of 9.4. This is a strong balance sheet that this company can go back and rebuild.
So what am I missing here? Why did Goldman Sachs get out of it when you see numbers like this? Surprises
Well,
me.
this company charging fees to Goldman was excellent.
Right.
But Goldman wasn't happy with their cut of the deal.
Gotcha.
So when you look at this relationship, there was a three-way partnership. This company loved it. They were collecting good margins. Apple liked it. Goldman hated it. They got the end of the stick. And so the Goldman says, I want out.
Yes.
But the other groups, it still was a good business model.
Yeah, makes sense. Now I completely understand. All right, levered free cash flow was what?
Yeah, so it was pretty flat, but that's because they spent close to $9 million on research and development, and that's going to bring them new ideas to bring to other groups and to pivot.
That's a
So
good sign.
yeah, so this is something that's interesting. It's if you look at it, there's a big story here. You have to really read and do some research, but it looks like an interesting play.
Okay. Moment of truth. Would you own the stock?
Absolutely. I think it's an interesting play. It's beat up. They have a strong balance sheet. Goldman and Apple loved what they were doing. It's just
Well,
that Goldman didn't like the defaults.
yeah, and I can see and understand that now. I'm glad I asked that question, but it totally makes sense. All right, 3 green check marks. On to our fourth one. And I'm already telling people now this is going to be a big fat red X, but it's a media company out of Canada. It's called mainstream media company out of Canada called Corus Entertainment. They specialize TV, radio, digital content. It's actually a company, as I said before, I used to work for. And as I said, a lot of people I've spoken to as far as in contributing towards the stock option plans for years have been hit hard and they don't know what to look for. But again, Corus Entertainment trades with the TSX under the ticker symbol CJR.B. Current share price 17 cents. Market cap. This was a stock I think a couple years ago was trading at $16-17. So as I said, 17 cents. Market cap 33.9 million. Shares outstanding 199 million, and daily trading volume is around 136,000. So that was a number of years ago at the $16-17 mark. But what's the last 52 weeks showing when you look at the charts?
Yeah,
Bill?
it's between 10 cents and $1.08, so it's down at the bottom range of 17
Yeah,
cents. About 10 years ago, this would have made the cut for the mid cap show if we had one.
yeah.
But now it's down
Not
beyond
now.
past the micro cap stage.
Well,
But
as I
there's a couple. Go ahead.
Yeah, I was going to say they focus TV, radio, digital content, assets like HGTV, the Food Network. They also made a big acquisition back in 2016 for Shaw Media of $2.65 billion. And if you're not from Canada, that was actually a major media competitor. That did not work out the way they were hoping to. But some acquisitions, and let's just face it, think of how much the mainstream media world and a lot of the properties, especially like I heard rumors, television and radio revenue was down 90% during COVID. Like, radio's traditionally you're commuting to and from your office. Nobody's going to work anymore, but that's how much it was down. But man, this stock, in addition to people looking at digital assets and the emergence of it all, a lot of these mainstream properties and traditional media have been hit hard. And this is no exception here at this company.
Yeah, the one thing I found interesting in this history is the thought process of the people who sold a lot of the assets that became Chorus. So you mentioned one of the transactions was Shaw. That was one of they were the original transaction as well. So the Shaws did quite well
Yeah.
in their history with Chorus. Um, the other group in Canada, the Demery family, which owns a lot of assets in France and in Canada, a lot of
Yep.
conglomerates in finance, Simple and such. They sold all their radio and media to Chorus as well. And so sometimes you got to sit back and think, if you have these astute families selling assets and some of them twice, you got to sit back and think, what is the strategic thought process of these investors that have done quite well? And I think that was one, if you look back in history, it's easy to look back, but that was at one time, that's something to learn when you see groups selling out of certain industries. It's something to think about.
That you probably shouldn't have a 75-year-old baby boomer making some of those acquisition decisions because I've seen it firsthand when I worked at some of the media companies. It's just it needs a complete and total rehaul as far as like who's leading these media companies. But the media landscape is predominantly owned by telecom companies, and a lot of their attention, let's face it, is towards telecoms. The media assets they use just to like leverage and brand all of their telecom assets. But when you are a Chorus, like Bell and Rogers are the predominant media and telecom companies of Canada, but Chorus does not have a telecom division. And as a result, like you said, you've made some acquisitions towards some dated radio properties. You can understand the writings on the wall, and that's the case, obviously, in this situation.
Yeah, no, for sure. And talk about dated, like in the small town that I live in, I go to these events in the town and they always have the radio advertising and they'll have media people from the radio station. But I've lived here, I think, 18 years, and I don't even know how to tune into the radio station if I wanted to. Like, I don't know how that works in my truck. I don't have a radio in the house. I don't even know how that works. And my kids, we were somewhere out and they saw someone had a radio and they asked me what it was.
Yeah. Yeah. That's reality, right? Social media. That's all you've got
Yeah.
now. If you go onto Instagram, Facebook, and you've got some sort of event going on, that's where people are and that's what they're looking for. But, when I look at Bell, how many people have they laid off in the last 18 months? They did 4,800 earlier this year and another 1,300 last year, and was all these small television and radio properties in smaller markets across the country. And the same thing's happening in the US as well. So I don't know what the decision making was involved in some of this stuff, but here we are, 2024, the here and now. So what can we look at as far as the stock, as far as revenue in the past 12 months? We look at the charts. What did it show?
Well, this is where it gets confusing for people because they see they had revenue of 1.3 billion still, but their revenue dropped last year 11.4. So
Yeah.
that's over over $100 million of a drop. They still have some gross margins. They don't do traditional accounting. It's hard to pull out the SG&A with it. They had EBIT of 274 million last year, so that's what gets people excited.
Yeah.
But it's except that the fact that it's when we'll take a look at the balance sheet and then also just the revenue potential is a sinking ship.
I think some of that revenue might have been real estate property that they owned in Toronto that they might have sold. I think that's what it's attributed towards. But let's look at balance sheet, current cash position showing what?
Yeah, so they have cash of 67 million, but their working capital is negative 130 million. They have a $1.19 of debt for every dollar of assets, and we don't even know if those assets are worth what they are in the balance sheet.
I know.
Because these are declining assets. And so they have a breakup value of negative 1.2 billion and a credit score of negative 8.4.
Wow.
It's a sinking ship.
That's crazy.
Yeah.
But like the Lehman Brothers back in the 2008 crash, you're going to see something like that where major networks, don't kid yourself, CBS's, NBC's, could we see them basically be bought out or falter in the coming decade? I don't think it's out of the question, because when's the last time you sat down and watched a sitcom? I haven't. But anyway, let's now move to their balance sheet. We looked at current cash position. And what about their levered free cash flow that they showed?
Yeah, it was 105 million, but as you mentioned, there were some real estate transactions that are skewing it as well, and the market's not being fooled by it. It's getting crushed.
Yeah. So tighten your shoes and run for the hills. This is not a stock that you would own, correct?
Yeah, for sure.
All right. So 3 check marks, 1 X. On to the final company here this evening. It's called CreditRiskMonitor.com, OTC under the ticker symbol CRMZ. Located out of New York City, current share price $2.22, $23 million market cap, shares outstanding 10.7 million, daily trading volume bills 7.9 million. SaaS platform, this company is, and they provide financial risk analytics. But before we get into company specifics about who they are, how has the stock performed over the past year?
Stock hasn't done much, so it's trading at $2.22. It's been between $2 and $2.65. So it's been fairly stable.
Okay, as I said, SaaS platform providing financial risk analytics, offering bankruptcy scores and financial data. You want to explain a little bit further on how it works and how many companies they're working with globally?
Yeah, so they have about 30 million companies globally that you can get credit reports outside of, and not just public companies, mostly private companies is where they specialize.
30 million? Wow.
Yeah. So the idea is that if a company is going to become a vendor of yours, you want to do some type of credit check. You want to make sure, see how they're doing. Getting it from a third party is good. There's an old group that used to do this. Dun and Bradstreet would do this. This is going kind of the way of the Better Business Bureau. Their way of doing business is very archaic. This is a modern way of doing it. You pay a subscription. You don't get cost per poll that you're pulling out data like with Dun and Bradstreet. And so they actually have 40% of the Fortune 1000 companies are subscribers of there and growing. But what's interesting is they provide a lot of three credit ratings on companies, and one of them is the Altman Z, which is behind our credit rating that we share. And then they have 2 other ones that are proprietary as well. And so I thought, this is a great service. This is something I would see as valuable as a business owner. You're giving groups credit. Yeah. Let's find out how they're doing financially.
Worth noting, too, that nearly 40% of the companies they serve are from the Fortune 1000 list. So that's pretty telling, to say the least, when it comes to validating this company. So is there any further plans when it comes to strategic growth for this company?
They're just going out and showing their service and growing, and then trying to cover more and more names and trying to bring more and more credit validation to groups, and keep bringing that out. So
It's
I thought it was a
working.
good model. It's something that I would purchase if I was lending people money on account payables.
All right, chart time. Revenue past 12 months along with growth percentage showed what?
Yeah, so revenue is about $20 million a year. Their growth last year was 5%. The growth over the last 3 years has been compounding about 6%. They have good margins here. 57% is what they make off their Fortune 1000 clients.
Yep.
Their SG&A is still there. It's at 50% because they're spending to get their name out there. Eventually, that should go down. But because the SG&A is lower than the gross margin, they have an EBITDA of 1.2 million. And that's pretty good for a SaaS technology type company.
What's usually on average for SaaS technology? Any idea?
Losing money.
Yeah. So
Yeah,
one.
because they usually have huge SG&As. But this one, because they have the gross margin, they can reinvest it into growing their business.
Okay, duly noted. Cash flow statement as far as current cash position and working capital showing
Yeah,
what?
yeah, so they got cash of 15 million. Remember, their market cap's 23, working capital is $7 million. So they have no challenges with their balance sheet, and we hope so, with them being in the business of giving opinions of everyone else how they should run their business.
Right.
Good to see they're doing okay on their own.
Yeah.
But yeah, so this is something that I think is well managed on the balance sheet for sure.
Yeah. Well said. Nothing like actually looking at your own backyard and seeing how you're performing while you're providing reports to see how
It's
everybody else is
interesting.
performing.
And on their website, as a sample, they give their own company's credit report.
Do they?
Yeah, so that was very transparent.
Well, they got to in that situation, right? I'm sure it's probably not a question they get asked a lot, but I'm sure it happens quite frequently. Credit score. What's their credit score? I'd be curious to see what that is. Do you know what it was?
It was just in the range of average.
Okay.
It was they're managing their balance sheet. I can see it with their growth. Like if you have if you have a gross margin at 57 and you're spending 50 on SG&A, they're managing their balance sheet just to slowly be growing. So
All right.
no surprise. They're just kind of in that average range of credit.
All right. Moment of truth. Would you own the stock?
I find this is interesting. I would want to use it. I've seen the other services like Dun and Bradstreet. That's archaic. So it's great to see a new entrant into the business.
Awesome stuff this week. Always love doing these shows with you, but these are some great finds to say the least. And obviously, like some of you might ask, like, why are we highlighting a company like Corus Entertainment? Because a lot of times, as we've said in the past, when it comes to retail investors, they look at stuff as is the stock basically on sale trading at 17 cents when at one time it was $16, or is it a trap? As we continue to say, when looking at a lot of these stocks, always look at gross margins and SG&A. That's a pretty telling component when you want to start and finish basically a small cap stock. Those are two very, very important stats. My friend, good work. And let's keep this show going and rolling. We get a lot of great feedback from last week's show, but we'll check back in with you next week. Okay.
Sounds good.
All right. Thanks, Bill. Hey, everyone. Thanks again for watching. Hey, we're humming along, and it's all because of you and the audience and community that we're building. So, again, make sure to smash on that like button and leave lots of comments. Who do we have up next? You let us know. Who should we interview? What companies? Is there anything you like? Is there anything we're missing? We're all here for you. Let's get on with each other and build this community for all of us to benefit. As usual, don't forget to subscribe to our channel, because in the end, we wouldn't be here without you. Thanks again, everyone.